And central banks from Washington to Frankfurt are telling us they're in a good place, and they have a point, even if that seems widely at odds with gestures at everything going on in the world. In this next report, we look at what could drag policymakers out of their happy place this year as we dive into another big week in markets. Take a look.
Central banking feels a lot like the internet's favorite dog meme right now. A pup sitting calmly in a burning room, confidently proclaiming everything's fine, when the reality appears to be anything but that. Federal Reserve Chief Jerome Powell took a leaf out of ECB President Christine Lagarde's book last week, telling us that policy was in a good place, even as the dollar went up in flames. Over in Canada, officials are getting increasingly comfortable with where interest rates are. That despite being the economy at the epicenter of President Trump's trade war. It was much the same message from Stockholm this week, and they all have a point. The global economy was remarkably well insulated from the varied political fires burning through 2025. Still, it doesn't take much imagination to see how we could exit this good place. New Fed Chair nominee Kevin Warsh thinks we already are. His argument for lower rates centers on AI and the wave of productivity it could unleash, lifting living standards without inflation. That may be true over the long run, but in 2026 it looks unlikely. AI or otherwise, the hiring data does jar a little with the Fed's more positive assessment of the jobs story last week. Now, we won't have the January payrolls data as per schedule this week. That is because of the temporary government shutdown before the funding kicks in. The jobs market is a big source of uncertainty, particularly when immigration appears to be falling sharply. For now, though, the Fed's mantra seems simple. Interest rates probably have a bit further to fall. But so long as unemployment stays contained, it can wait for more evidence that inflation has cooled further. The vibe is that this won't happen until the summer, with analysts pushing back their Fed rate cut calls to June. That unless the delayed jobs report next week and the one after it is a disaster. However, that's not what analysts expect. The real question is, what is that thing which pushes the Fed out of its happy place? Bumper tax refunds are likely in February. But the bigger question is whether Congress votes in more fiscal stimulus ahead of November's midterms. That election will be heavily fought on affordability. If it does, and any extra spending starts fanning the flames of inflation, that could become an issue for a Warsh-led Fed later this year. For now, central banks are still sipping their coffee in the corner, and with good reason. But the question is whether 2026 brings the moment they look up and say, this is not fine. Business Bureau, WION, World is One.